Should we follow our names?
Where did I come? Yeah. Well, there we go. Look at that.
Do I just start it? Or?
I think you just kick it off.
I think so.
Hi, everyone. It's great listening to David Kelly. I'm also with JP Morgan, so it's always a treat to hear David Kelly. Today, we are talking about allocating to Bitcoin and other real assets. Exciting topic. A little history on myself. I ran model portfolios at Merrill Lynch for about 10 years and ran models at Global X for about 7 years. I'm now part of JP Morgan Asset Management. Not supposed to talk about Bitcoin, but certainly going to let these fine folks talk about Bitcoin. So we're going to talk about how Bitcoin, other cryptocurrencies, blockchain, other real assets can fit into portfolios. This is kind of a new age we're at and trying to figure out the right allocations for those types of new asset classes in the ETF structure, of course. So I'm going to let my panel introduce themselves. So Teddy, and then we'll go down the line and then we'll kind of take it from there.
Thank you, John. I talk about Bitcoin most of the day, every day, so a little difference and excited to talk about it here today. First of all, I want to say thank you to John Davi for putting on such a great event. Thank you, John. I don't see him in here. He promised he would be in here for this panel, but if someone can track him down, that'd be great. I'm Teddy. I'm the president of a company called Bitwise Asset Management. We're an asset management company that focuses entirely on digital assets, cryptocurrencies, and related products. Primarily, we build investment products for professional investors. Think ETFs, exchange-traded products in Europe, that type of thing. We also own a staking business that helps institutional investors to participate with blockchains by staking their tokens. It's something that we probably won't get to today, but if we talk afterwards, I'd be happy to share a little bit more about it. And excited to be here with you all today.
Right. Paul Bayaki, head of fund sales and strategy at SS&C Alps Advisors. Alps is an asset manager within SS&C Technology, which is a S&P 500 financial technology company. And I got introduced to the ETF wrapper in 2008 or so. I was going to grad school and I was working for an RIA that was a sub-advisor for a firm called Claymore, which was building UITs at the time. And they came to us and asked us to build an index for a global coal ETF. And the reason I bring that story up is because then I got introduced to the ETF wrapper. It became what has become my career in many ways. And along the way, I was fortunate to meet some really influential people in the ETF industry along the way. And it harkens back to seeing Dave Abner here when I was interviewing for a job at Index Universe, which became ETF.com. Don Friedman, Dave Nottig, Matt Hogan, your counterpart, were all there. And Dave Abner's seminal book, the ETF Handbook, was part of my prep material as I was looking to start out in a research capacity in the ETF world. And so now, 15 years on, to see the way the industry has evolved and to see an event like this, largely focused on ETFs, but also macro conversations, is just really rewarding. And so I'm excited to be here.
Well, it is a small industry. There's a lot of people in this room we all have a lot of connections to. So I'm Jeremy Schwartz. I've been at WisdomTree 20 years, so I've seen us grow from sort of white paper, how to index, away from market cap to fundamentals, to today we're about 140 billion globally, US and Europe. We made an acquisition in Europe about in 2018, and now we have about 24 billion in gold. So this real asset topic is very topical. We're doing a lot with crypto. But also now we just made a recent acquisition also in real assets in a new space for us, another alternative, trying to get income with inflation protection. So I'm excited to talk about all that with you all today.
Well, thanks, Jeremy, Teddy, and Paul. Before we kind of go into some of these fun topics, the ETF industry is about $13 trillion in assets in the US, about $17 trillion globally. We're seeing that ETFs are going to all these different spaces. My firm is focusing on actively managed ETFs. Single stock levered ETFs are considered actively managed. We don't do those. Now, I've been building portfolios for the better part of 20 years. And ETFs, because of their unique benefits, they're liquid, they're transparent, they tend to be cheaper, both active and passive, the tax efficiency component, and they're accessible. They're covering almost every different part of the investment ecosystem, from Bitcoin to gold. to uranium to large cap growth and derivative income. Now, from my perspective, ETFs are just these fantastic building blocks, much better than mutual funds because of the tax efficiency component. How do you, let's start with Jeremy. How do you see ETFs in terms of building blocks of asset allocation, kind of before we kind of go right into Bitcoin and AI and different real assets?
Well, I think you hit it exactly. Like, I think it's just a wrapper. It happens to be a very useful wrapper, and so you could say you could hold an index through an SMA, and there's SMAs are becoming more and more popular for tax loss harvesting and all sorts of uses, and people doing leverage with all that. So there's all sorts of uses, but the ETF is just a clean, transparent wrapper. When central banks, think about like the Japan Central Bank, when they were buying stocks, what did they do? They started buying ETFs, right? Because it's just a simple way for them to get executed in the market. And I think that's the short story.
Yeah, so it's interesting because I think people view ETFs as a panacea for what ails their investment strategy. And the truth is, if you're a bad active manager, you're going to be bad in the mutual fund wrapper. You're probably going to be bad in the ETF wrapper as well. If you're a bad asset class, just because you're in the ETF wrapper doesn't make it all of a sudden good. And a lot of the product, quote unquote, innovation that has come along in recent years, I don't know that has been additive to your typical asset allocation framework that an advisor is using to deliver solutions for a diverse client base. And that's not to say that leveraged single stock or defined outcome or buffer ETFs aren't additive, but it's important to note that most of the money going into ETFs still goes into the very basic building blocks of an asset allocation framework. And increasingly, as we've heard from a lot of the speakers today, the biggest piece of that, 60-40, 70-30, whatever it might be, is S&P 500. And the biggest piece of the S&P 500 is concentrated in very few companies. And so although there's been a lot of innovation in what I would call adjacencies to that core asset allocation framework, some of the pockets of a typical asset allocation framework haven't necessarily been visited or revisited by advisors, and that's, I think, where real assets might come in.
So getting into kind of the nitty gritty of this conversation and the fun part, David Kelly just talked about the dollar's depreciated about 10% this year, and he thinks it's going to continue on for the foreseeable future. Gold is up 55%. Bitcoin and Ethereum have done rather well. Now, as an asset allocator, I would tend to use small portions of gold. I've never allocated to Bitcoin, but they're in ETF form. Financial advisors and just end investors can certainly include in their overall portfolio. How are you seeing Bitcoin, Ethereum, other blockchain technologies being utilized in portfolios? The volatility has been relatively low because they've been going one way, up. So I don't think that's a great indicator, but I wanted to get your thoughts and what you're experiencing.
Yeah, absolutely. I think that what we just talked about a little bit is first enablement. Like a year and a half ago, most advisors and institutions weren't allocating at all because the portfolio construction tool wasn't there. Right? The ETF became what we call the easy button for the allocators to actually start using it. And before that, it's not that there weren't some professional investors and some early adopters and some folks who were creative about how they could get the exposure. It's just that it was the tool, the main tool for building portfolios wasn't there because Bitcoin wasn't available in the ETF wrapper. And so that changed things dramatically. That was the beginning of 2024, January 2024. And since then, we've been able to learn a lot more from our clients about how they're using it, how they're thinking about it, what sleeve does it come from. And you said, well, what about Bitcoin? What about Ethereum? I think the honest answer to that is it's primarily the conversation is about Bitcoin right now. Ethereum is a little early relative to professional investors allocating. And with Bitcoin, we tend to see it from allocators who do have a gold allocation, from those who have either like the debasement trade has become a very popular term these days, or an inflation hedge part of their portfolio, or a physical commodities part of their portfolio. That's the sleeve from which we tend to see Bitcoin allocations, primarily using the ETF. And we see small position sizes, as you can imagine. 1% to 5% is the range of the conversation that we're having.
Right. Paul, in terms of other real assets like MLPs, and how are you seeing investors allocate, particularly in this environment?
Well, in many ways, it gets back to the concentration concept where a lot of the market's total return has been concentrated on very few companies, most of which are mapped to the AI story. And the AI story is very much about chips and NVIDIA and all the GPU demand that they're seeing, and then these circular vendor financing agreements that are starting to pop up in the ether. But in many ways, Bitcoin and AI are kind of abstract concepts for most people because you plug something in, boop, 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 into your magic machine in your pocket, and then a prompt comes back and answers your question. Or you go and you enter an order for, say, the Bitwise ETF or another Bitcoin-oriented ETF, and nothing is tangible about that experience other than maybe you touching your phone or your computer. But behind all of that, whether it's blockchain, whether it's AI, whether it's electrification of the economy, there are real assets that need to be invested in order to unlock it. An example is copper. We need a lot of copper in order to expand our transmission, expand the overall capacity of electricity in this country so that we can meet our lofty AI ambitions, so that the mining facilities do have the power when they need it. And so in many ways, we're trying to bring back some of these concepts to the reality of the world that we live in. And so pipeline companies that are in AMLP or ENFR, for example, are tasked with bringing the natural gas that's produced in the United States to the utilities or to the consumption sites so that the electricity is there and reliable when someone enters a prompt into their LLM, or so that the mining facilities around the world are able to function. And then you start to get into some of the emergent technologies like, say, small modular reactors, which have been in the news of late. And a product like, for example, Elfie, which is designed to capture the electrification theme, is ultimately a play on, once we've invested all of this CapEx into ensuring that we have the data center capacity, the mining capacity, the transmission capacity, who are the companies that are going to benefit? It's copper miners, it's uranium miners, it's midstream energy infrastructure companies, it's utilities companies, which in many ways are real assets at their core, but are also importantly portfolio diversifiers. Because if you look at the S&P 500, 35% is in technology. 2% or so is in utilities, 2% or so is in materials companies. Both of those sectors are critical to our ability to meet these lofty standards, these lofty expectations in terms of all of that CapEx and all of that opportunity that Bitcoin and AI and all of these technologies promise.
Yeah, the increased energy usage is not expected to decrease, go in the other direction. So are utilities becoming something different? I would imagine, just because of the energy use. And even like, I know ESG is certainly not in vogue, but solar is probably taking some role because that's kind of a proven technology. And even with the tax credits going away for adding solar to your house, I'm sure there's other subsidies, whether it be the solar companies or making the panels in China and things like that.
Without a doubt. And if you think about defensive sectors, so the market was always broken up into cyclical and defensive sectors, and the three sectors historically that were viewed as defensive were utilities, staples, and healthcare. Well, healthcare has been on a very difficult road over the course of the past 3 years. It had two of its worst periods relative to the S&P 500 in history. Utilities is trading at 2 turns above its historical multiple, so it's trading at a premium to where it's typically traded. The best performing stock in the S&P 500 was utilities. So in some ways, this defensive sector, which has not had growth in the past, is looking at a future where electricity demand growth in the United States, which was 0.4% annually, is going to grow to, depending on your estimate, 3% annually, which means additional revenue and additional growth opportunity that might not have existed in utilities previously.
And Jeremy, with maybe going back to gold for a moment, gold's up 57% this year. Are we chasing that trade at this point, or with the expected continued depreciation of the dollar, is that still a good diversifier?
Well, I think it's really interesting about like what's driving gold and Bitcoin, and then tying it back to Mike Green's conversation, like where Mike's saying all the flows are driving the S&P and these sort of concentrated large caps. And I think when you see some of what was happening, what got people excited about Bitcoin again was the ETF coming to market. To Teddy's point, it's enabling all sorts of new money to come in. Yeah, you had the sort of millions and millions of people with the Coinbase accounts, but now we're going to get into the traditional advisor community and bring it up. And you did see flows driving some of the performance. Now, if you look this year, I don't have a clean one number, but for the crypto ETFs, I think there's been about 40 billion today. And there's like 10 billion in Ethereum or at least in one of the Ethereum ETFs. So it's probably like 3/4, 1/4 of that 40 billion is roughly Bitcoin. It's like 140 billion total of the ETFs that I track. Gold, is the percentage of gold to Bitcoin market cap, was it 30 trillion versus 2 trillion, something like that? So 30 trillion for gold, 2 trillion for Bitcoin. How is this rally in gold being driven by ETFs? Short answer, I don't think so. Like maybe recently, the last 3 months, you start seeing some gold flow, but most of the rally was central banks in Asia, China central bank, the Russian central bank. You heard somebody talk about if you were China and you saw what we did to Russia cutting off your treasuries, would you want to hold treasuries? It's very tricky. They get a lot of dollars they're selling into the US, but what are they going to do with those dollars? So I think gold, my boss, who I worked for the last 25 years, Jeremy Siegel from Wharton, he was one of my longtime mentors. He wrote Stocks for the Long Run, said gold over 200 years just kept up with inflation, sort of did a little bit less than 1% real over 200 years, but last 50 years, it actually was the second best versus stocks in real terms. But like, where do you sell in your portfolio to add gold? That's the real tricky question is, all right, 1% real over 200 years, stocks were better, bonds were better, doesn't have an income, so like, what do you do? So I think, that panel that Corey and Shana, and they're talking about capital efficiency, I think is really the way. It's like, how else are you going to add gold into portfolios? And I think that is sort of one of the interesting things. But I would say it's not ETFs driving gold. It's just recently, it's more like the central banks.
Is that why you think gold and Bitcoin don't always move together? I mean, there's some days when the dollar weakens, you think Bitcoin would be more of a store of value and would go up, but if volatility is high, sometimes it comes down. So in some days it's more correlated with volatility.
Well, I think you see in the recent weeks, a little bit of the flash crash over the weekend with all this leverage in the system, and so you get this leverage drawdown, and there's more volatility today, and so it's definitely a different use case, but it's definitely a different community. Like I often make the example of like my dad versus my brother. My dad was a gold guy and had a lot of gold. My brother owns nothing but Bitcoin, right?
Yes.
So. And like probably no stocks. I've worked on stocks for the long run. He owns a lot of Bitcoin. Okay, so that's the mentality. Now, so I think there is a generational thing that I don't like the term digital gold. We hate that term because you could actually tokenize gold and move it around. But this generation's gold is the younger generation's gold. I think is a good way to think about it.
Yeah, I think just building on Jeremy's point, a lot of the conversation that we have with professional investors or with advisors is about Bitcoin being an emerging store of value, being an emerging storehold of wealth, being an emerging, I know that Jeremy doesn't like it, but digital gold is the narrative that has mostly caught hold with the investors that we talk to. And what does that mean when I say emerging? I mean, humans have been hoarding gold as an investment for thousands of years, right? Humans have been hoarding Bitcoin for like 10 or 15. And so how does a marketplace get incepted? How does an asset class get incepted? There's going to be a lot of bumps in the road, severe drawdowns in volatility. We've seen that over time, that has been how Bitcoin has performed, and we expect to continue seeing some of that. And that means that these market dynamics, Jeremy sort of alluded to it, but there remains an important part of performance, volatility, and liquidity driven in the digital asset market by these offshore derivatives exchanges, where you have a lot of retail investors who are, frankly, just punters trading with leverage that can get wiped out on a Friday night when the market moves very rapidly. And that's technically something that impacts the price of all digital assets, Bitcoin included. But what we think is that dynamic over a long period of time becomes less and less important as investors do look to the future and they think, okay, gold has been this thing, decentralized, supranational, valuable in India, valuable in Brazil, valuable in America, valuable in China. We think that Bitcoin is the thing that can play that role in 10 years, in 20 years, in 50 years, in 100 years. So people often talk to us about like the 4-year cycle, and we study it and we pay attention to it. We also talk about, okay, what's the 100-year cycle? What's the 20 or 50-year cycle? And that's sort of it's still, people, I think, give crypto folks a hard time for saying it's early, but I just think in terms of market adoption and relevance, it still really is it's a brand new asset class.
Do you guys have suggested allocations for digital assets? And have you done studies on those?
We've done studies on them. I wouldn't say that we condescend to suggest, so far as our clients tend to be better at their own asset allocation than we are. But the studies that we have done show that very small allocations to Bitcoin, single digits, 1 to 5%, rebalanced regularly and managed appropriately, have outsized positive impact on your risk and return profile in your portfolio. And that's because risk, Matt Hogan, our CIO, is fond of saying this. The risk tools love Bitcoin because it's volatile, it has massive upside, and it has significant drawdowns, and over a period of time, it's not correlated with the other assets in your portfolio. And so the risk models love it. And so if you add it using an intentional small strategy, you rebalance it regularly, then your portfolio simulator is going to love it.
The question will be, here's a question I have, is Bitcoin going to be like gold in the sense of, when you look at commodities, broad indexes for commodities, there's not that much money in them. There's a lot of money in gold, but not a lot of money in the broad indexes. And so the question is will the S&P, will the cap weight index of crypto come to generate interest, or will Bitcoin always be this special thing? Will people, in that in the ETF world, that, it's basically the index, equities, bonds, even now, you've got a lot of money going towards indexes, but will it be sort of like commodities in that sense?
Yeah, it's a great question. I don't know the answer, but Paul was asking me about Solana outside earlier. In Ethereum, you asked about at the beginning, right, John? I think a major difference when we have these serious conversations with investors who are evaluating whether or not they're going to actually invest in digital assets is why? What's the story? What's the theme? And I think that we bucket all the cryptos in together, including Bitcoin, because it's based on this blockchain technology. That's the innovation, right? Yep. Distributed systems, blockchain technology, it's amazing. But the investment story for Ethereum, for Solana, for some of these other assets, to us is a very different one than it is for Bitcoin. It's a very different thesis.
Well, Bitcoin's a store of value, and Ethereum and Solana, they're systems that you can build onto and integrate into the financial system.
Yes, exactly. I think Ethereum, Solana, I think they're tech stories. I think they're software stories. Solana, Ethereum, you can run programs on them, you can run applications. The protocol itself can earn revenue. If you invest in Solana right now and you stake your Solana tokens, you can earn 7 to 9% in rewards of Solana tokens annually. You can measure the cash flows. You can look at the network's revenues. You can't do that with Bitcoin, right? Yep. Bitcoin's people can be insulting about it because Bitcoin doesn't do anything, right? It's just there.
Like gold.
Like gold.
So, Paul, to bring it back to you,
Yeah,
talking about some real assets and including that. So, are you experiencing an increase in energy type exposures and with your clients?
Yeah, to a degree. I mean, if you look at the energy sector as measured by something like XLE, the largest, most liquid energy ETF on the market, $7+ billion in outflows this year, $13+ billion in outflows over the course of the past few years. Nobody wants to own it. Its share of the S&P 500 is 3% by weight. And yet you've seen inflows into midstream. And I think part of the reason you've seen inflows into midstream is there's a yield story there. Yeah. It does provide an AI adjacency, again, understanding the pipelines and their role as they play in the AI investment and the infrastructure development necessary. But to get back to gold and Bitcoin as it relates to a portfolio composition strategy, it's always important to bring it back to the concept, right? You talked about Solana and Ethereum, smart contracts being built on there, stable coins being largely built on Ethereum, Bitcoin being a store of value. I think advisors telling clients the story as to why they're invested in a certain asset class, that works. With gold, it's a diversifier, central bank buying, okay, that works. But if the rationale for Bitcoin or for gold is the world's going to end and there's full societal collapse, Having Bitcoin's probably not going to do you much good. Having shares of GLD probably not going to do you much good. You might want to buy physical gold and store it with your gun under your bed. The point is, all of this has to relate to how advisors actually build portfolios, the models that they digest from an OCIO framework or otherwise. And so from our perspective, when you talk about commodities, it is that gold is a big piece of the overall commodity landscape. Energy dominates global commodity benchmarks because most of them are production weighted or liquidity weighted. That's been to the detriment of commodities. If you look at the GSCI year to date, it's up 5% or so in a year in which the S&P 500 is up north of 13% coming into the week. So it's about diversification, of course, but the role it plays in the portfolio needs to be clear and it needs to be concise. And with commodities, it's deficits in key commodities like copper that are likely to persist, not get better, but most likely get worse. And what are the knock-on effects for global trade, the global macroeconomic landscape, and then how does that translate to relative performance in a portfolio suite?
Got it. Now, we talked about cryptocurrencies. It's based on the blockchain technology. We're hearing a lot about tokenization. I'm going to start with Germany on this one. You guys purchased a farmland company. Do you see that farmlands are things that will be tokenized, and should they be?
That's a great question. And like when we started our tokenization initiative, we actually started with the most mainstream real-world assets you can do. So we built an app, WisdomTree Prime. It's built on the blockchain, but the goal is for you not to know it's built on the blockchain. It's just to be a seamless app that you can hold your crypto, Bitcoin and Ether, right alongside your core S&P 500, 3 different Siegel funds. We've got the whole bond curve, a money market fund that I have tied to my debit card, so I go swipe my Apple Pay. Is coming directly from a today almost 4% yielding money market fund instead of your 0% yielding bank account that everybody has, right? So it's the technology is amazing and it leads to a good experience. Now, people have done these things like art and people ask, are you going to tokenize farmland? And that was sort of how part of the conversation started, but we're not, in the short term. Like it's not there. It's like, can you bring the tokenization to the most competitive assets? And why should you only be transacting 9 to 5, 5 days a week, 24/7 across the major assets? You could eventually swipe your Apple Pay with your gold token and have your old gold standard. You could do it from our equities. You could have all sorts of interesting things with the tokenization feature. So transforming spending for mainstream assets is part of our vision. WisdomTree Prime is a direct-to-consumer, but people are using it institutionally as well, where DeFi platforms like Ondo, as an example, is a tokenization that's doing with treasuries, is using some of our money market funds in their ecosystem. So it's beyond that.
Yeah,
Well, Tiffany,
yeah. So tokenization, the discussion comes at an interesting moment because we've heard a lot recently about DFA getting approved for ETF share class to be bolted onto their mutual fund share classes. There's 80 plus firms who have filed for it. And in conversations around that topic, I've heard people say that tokenization of mutual funds and ETFs might come sooner than the actual ETF share class. And the reason is because, first of all, the DTC is ahead of this. They've invested in a company. They're trying to build the infrastructure and the rails to enable that. And in many ways, the ETF wrapper itself has some limitations as it relates to the most efficient way to invest in certain categories. So you've seen it, John, thinking about a simple dividend strategy. So let's say you buy the highest yielding stocks in the market, and that's what you own because you want more dividends. Well, those companies all pay their dividends at different times into a pool, and then the ETF pays them out quarterly, or maybe monthly, but for the most part, they pay them quarterly. In between when those dividends come in and when they're paid out, there could be creation activity in that ETF, there could be redemption activity in that ETF. So what's paid in by the companies into that ETF does not translate exactly to what the ETF investor realizes. Let's say you move to a tokenization framework whereby the companies pay those dividends into the ETF or the tokenized version of the ETF, and then you get a stable coin immediately when those dividends come in, or the equivalent of a share reimbursement program, you get a partial token for the dividend equivalent in the ETF. In my mind, that would be a massive advancement in terms of the efficiency of investing in a pooled vehicle to get access to a broad basket of companies that doesn't exist now because some of the limitations around the ETF wrapper. But it is certainly something that we've seen happen in the money market space. We've seen BlackRock, I believe we've seen JP Morgan offer tokenized money market funds. It's also, in theory, an opportunity for US-based strategies to be available in Europe or in other parts of the world, because in theory, they can be accessed anywhere.
Yeah, I mean, so Bitwise is a San Francisco-based venture-backed startup company. We got funded in 2017. That's when we started the business, opened our first fund. We worked very closely with a number of these blockchain products as they were getting off the ground. And Jeremy said something like, yeah, the stock market closes at 4 p.m. on Friday. Like, to me, it's just crazy. It's like we send emails, text messages, tweets 24 hours a day, 365 days a year. And for some reason, the stock market closes at 4 p.m. on Friday, 4 p.m. Eastern time on Friday. And then it's closed for most of the weekend. It's just the underlying, my career before getting into Bitcoin and crypto was in building exchange traded funds. I've worked with many of you in the room, bringing products to market, launching them, working with custodians, market makers, exchanges to make it happen. It's just like that underlying infrastructure compared to what is possible now is just old. It doesn't work at a 2025 speed. What is possible on chain now through tokenization, I think tokenization becomes like a little bit of a buzzword where people don't quite grasp how much it changes things. It's like what becomes possible through tokenizing anything is that you can now interact with that token and use it for things on chain 24 hours a day, 365 days a year. And that means that anything is possible. The big market that I think people don't understand is so ripe for disruption is actually big banks, prime brokerage lending businesses. Because right now, I mean, most of you run ETF businesses and you don't know how to calculate how much it is that you get charged for borrowing securities or why you make what you make on securities lending. It's opaque. The prime brokers own this business, right? You can, if each individual owns their own tokenized stocks, there will be a securities lending rate for each one of those individuals to loan out their stocks. Yeah. There will be a margin rate that they can choose from a decentralized loan pool, how much they want to post into that pool to borrow stablecoin out of it. And they can get that loan in 30 seconds, as long as they meet the pool's rules for margin and collateralization. This is all possible now. It's just that it's not widely offered to everyone.
How long do you think it'll take before markets are 24/7 everywhere? Because then you won't have to deal with non-concurrent trading hours. And I mean, like, how does that even look? I mean, you have to.
In terms of how, like, I actually think about it more like email. Like, email is a protocol. You can send an email tonight at midnight or right now, and there's no one who can stop you from sending an email. The way that these blockchains work is the same way. It's an underlying software protocol. The thing that hasn't caught up to the capabilities of the protocol is the regulatory environment. It's not the business appetite, it's the regulatory environment, right? And if the government ever decides to come back to work, which may or may not happen sometime soon, the new chairman of the Securities and Exchange Commission, Paul Atkins, who was actually one of the early industry advocates for getting positive regulation done for crypto in America before he took his role, he is the one that has said he wants all stocks and securities to go on chain. And so there's a battle lines have been drawn up on Capitol Hill, and there are vested interests who want to slow things down, who want to continue to control the $40 billion in estimated annual revenues that prime brokerage businesses make, so that they can control the stock loan markets, et cetera. But the SEC under Paul Atkins wants to make all this stuff available, and they want everything to go on chain. So I think it really depends. I don't know if we're going to get legislation this year, but this next market structure regulation that is supposed to be going through Congress is going to be a big tipping point in whether or not this is something that might happen in like 2026, or if it gets slowed down until after the midterms.
Any thoughts, Paul? Or
the technology is going that way. It's definitely, you're hearing it from the administration. There's going to be more progress. Is I think the short story.
Great. Well, you know, I think the tokenization, cryptocurrencies in portfolios, different blockchain technologies within portfolios, gold, particularly in our current environment, is going to be interesting. Asset allocation is certainly shifting and changing. We have a few minutes, so we'd love to open it up to questions. Yeah.
Becoming one of the largest purchasers of treasuries and how that's going to shift the market.
I can take that one. The question was, well, what do I think about stable coins becoming one of the largest purchasers of treasuries? I think it's in our country's interest to support U.S. dollar denominated stable coins. And the way that in the digital age that we're in now, even though we still close the stock market at 4 p.m. on Fridays, is to support U.S. dollar denominated stable coins so that they can buy U.S. treasuries, so that U.S. dollar hegemony can be continued into the internet era. And I think it's a very positive transition for our global reach with the U.S. dollar, given that geopolitically several of the prior large-scale buyers of treasuries are likely to be not doing that as much in the future.
I'll give a little hot take here.
Yeah.
So the stablecoin is just like a traded bank deposit, okay? So you give your money to the stablecoin issuer, Tether, they get to earn all your spread income like a bank does. So, you know, how about our tokenized money market fund earning 4%? Stable value, you spending off of that, right? That is a much better innovation. Like talking about, you know, taking control of your lending. How about your bank deposit, which everybody has too much cash in the bank earning nothing? That is like a key difference, right? That is now, is it technically a stable coin? Well, under these different Genius Acts and rules, maybe not yet. But that is the real innovation, not the fact that you could have a stable coin that you could use for some transactions online. It's taking for the natural money market rate and earning it while you spend.
Yeah, I agree with Jeremy. The fascinating thing about Tether, I don't know if you all know this, is they may be the most profitable company on a per employee basis in the history of the world. They take all of the income from the treasuries and they keep it for themselves. they don't give it to the token holders. We just got earlier this summer, finally, we just got legislation through the Genius Act that will make clear what the regulatory environment is for stablecoins. I don't know if I don't think that the stablecoins are going to pass that interest back through directly, but what I anticipate will happen is that there will be more competition in the stablecoin space, and that the platforms that you own the stablecoin on will start having to share that interest income with their users. So at a minimum, I expect that to happen in the next year to 6 months.
There's $7 trillion in money markets, so that'd be interesting to get some of that.
Crazy.
But it's the bank deposits, right? The money market fund you have, but can you spend from those? Maybe some is easier than others, but it's the trillions in bank deposits earning nothing that is more transformational for it.
Yeah, and incentives are always important. So you think about Solana. You said you can earn 7-8% staking it. I think the yield on ETH or the staking rewards on ETH, 3 or 4% currently. You launch an ETF, they approve staking within there. The question will be, how much of that staking revenue is held by the asset manager and how much actually gets collected by the investor, and whether or not that trade-off that you're making to be in Solana with the volatility or ETH with the volatility paired with whatever yield you're getting or staking reward you're getting, how much of it is cleaved by what the asset manager is taking and what the outcome is versus a tokenized money market fund or what an alternative investment might be.
I agree. And here's still where ETFs are an amazing financial innovation, right? Because of the transparency of the product, you'll be able to tell.
Yes.
And then so if one person is trying to cleave off 30% and the other one is giving you 90%, then you'll have the ability to look, to see, and to choose the one that's giving you 90.
And not to push back too hard, but SEC lending revenue within ETFs has been a pocket of the market that has not been as transparent historically as maybe people assume, because some people will report the net figure, which covers their operating costs, which you don't necessarily know what they are. And so I agree. The ETF wrapper is a fantastic innovation, perhaps one of the most important to the end investor in the history of financial services. But there are ways to hide things in the wrapper.
Thanks, Chris.
Flash drive.
Get ready to staff that desk 24/7,
More employment. We just talked about AI needing employment.
including on Christmas and New Year's.
Yes, sir.
Do you guys foresee stablecoins, any unregulated stablecoins or stablecoins off the blockchain in this country?
So going off the blockchain, meaning going onto a different like set of rails?
Yes. Or just not, getting approval to be, digitally direct with participants, but not on the blockchain or not tracked on the chain.
I mean, I don't know. Like, I think it depends. Like, sometimes with these blockchains, it's like a matter of definition, right? Like, the banks are now going to be able to get into stablecoin. That's one of the things that the Genius Act did. It allows banks to participate in stablecoins. But how are they going to do it? Like, you think they're going to put it up on Ethereum or on Solana? I think it's probably more likely that the biggest banks are going to make their own consortium. They've already tried this a couple times in the past, right, Jeremy? Like, didn't work out that well. But they're going to make their own consortium. They're going to have, some private blockchain, or they're going to privatize some version of the blockchain, and they're going to run a shared database. Is that, like, maybe that's what they're going to do? The thing that's beautiful about the stable coins is that they're lightning fast, and they ride around without an intermediary, right? We can use them without going to JP Morgan or without going to, hey now, yeah, without going to any bank. And so, like, if you take that away and you put it on a different technology, I just don't know if the network effects are there.
Last question.
Listening to David Kelly and obviously the immigration issues where there's less people coming in. EV has not been really the biggest driver of or the incoming wave of desire that we originally thought it's going to be. So what's kind of going to be driving real assets and the need for it, or is it going to be more of a sustained effort in assets?
Yeah, so I would say it's a combination of a confluence, if you will, of trends. So we do have the AI investment that's going to require a tremendous amount of investment in raw materials, specifically things like copper. You think about cement, construction materials required to build all of those facilities in massive demand. You've also got, yes, EV adoption is not accelerated at the pace that maybe some of the projections estimated, but at the margin, increased EV adoption increases the demand for rare earths and some of the metals that are required for construction of EVs, as well as increasing, again, at the margin, the demand for electricity. Then you layer on that, switching from gas stoves to induction stoves also increases at the margin electricity demand, reshoring of manufacturing activity. I don't know if you believe this administration, but they said $13 trillion in committed investment. I don't know if that's the actual number, but talk about all of the manufacturing capacity that in theory is coming back to the United States, which requires more electricity. And so reshoring, internalization of economic activity here in the United States and globally, and then repurposing of supply chains as a result or response to tariffs toward other end destinations will require infrastructure investment as well. And so I would say it's not any one thing as much as a confluence of different drivers.
Debt and deficits need inflation, so you need inflation protection.
Well, thank you very much, everyone.